Hey, what's up everyone? This is Craig from Behind the Banker's Mind. Today I'll be discussing with you the subject of understanding bank credit, and I'll be giving you the 5 C's of credit which the banks look for in terms of lending you credit. So stick with me right through the end and hit that subscribe button if you haven't already, and click on that notification bell to receive notifications of my new videos that I'll be uploading each week. So without further ado, let's jump right in. So, understanding bank credit. If you're an SME operator, learn these basic thoughts. When you speak to your banker for finance or startup capital to support cash flow requirements or manage your asset growth, understand that your banker does not see your business potential or prospect the way you do. They sit in the seat of the lender or the creditor as opposed to you as the borrower or the debtor. The first thing that hits them hard is the risk. They call it credit risk. The question they ask without asking you is, how safe is the risk they are about to commit to? They call it credit risk exposure. How fast can they record the debt should the loan goes into a default position? So they apply what is known as the 5 C's of credit. There are up to 7 C's of credit, but for the benefit of this discussion, we'll not narrow that to 5 C's of credit only. So number 1 is the character. Banks want to understand whether you are a good customer and have never defaulted in any past credit experience. Capacity is the second. Banks want to understand whether or not you have the potential or the ability to make repayments as and when they are due. Capital is the third one. Banks want to lend to customers who have the ability to generate any form of initial to startup finance or capital. If you can't, it's already a gray spot on your standing as a borrower. The fourth one is the collateral. Banks will always ask for a certain security contribution from the borrower. They often call that equity contribution. From personal and corporate banking experience, equity doesn't guarantee you a line of credit or a loan. It is a safety buffer or cushion the bank takes. And the last one is condition. Banks want to understand whether your business is growing or faltering. If you answer the 5 C's on the positive, then you have just qualified your application for a line of credit. Should one of the 5 C's lack in good rating, that automatically disqualifies your potential for credit. So I encourage my fellow Papua New Guineans to understand this before you make an attempt to the banks to acquire finance for your business. So before we wrap up, I want to just take you to the 5 C's of credit again. Number 1 is character. You have to have a good standing. Capacity is the second one, which is the ability to repay the bank. And third one is the capital, what it takes to start. And the fourth one is collateral, is the ability to securitize the debt or the loan you are taking. And the last one is condition. So I thank you all for watching, and I'll see you all in the next one.